The 2-year Medicare trap, stealing $12,480 from your Social Security. Your 2026 Medicare bill is already being set by what you earned in 2024. That letter you got, not your fault. It's a built-in trap. The system uses a 2-year lookback that can slap you with surcharges even if your income just dropped. Today, I'll show how the lookback really works, why $1 over a bracket can cost you hundreds a month, and how to erase those surcharges legally. Yes, up to $12,480 saved with a simple reset. Stay with me, because the most common SSA-44 mistake triggers an automatic denial. First, here's why this hits you 2 years later. How the 2-year lookback really works. Here's what most people miss. Medicare doesn't look at what you're earning today. It looks at IRS data from 2 years ago. Social Security pulls your modified adjusted gross income, MAGI, from the most recent tax return the IRS has on file, and uses that to decide if you owe IRMAA, the income-related monthly adjustment amount, on Part B and Part D. Why this matters: if you had a spike in 2024, an RMD at 73, a Roth conversion, selling a rental, or realizing capital gains, that number shows up in your 2026 Medicare bill. You can be retired now and nowhere near that spike, but the system still charges you like it's happening today. That delay is the time travel tax. Income then, penalty later. Let's make the flow crystal clear. The IRS reports your 2024 MAGI. 2 years later, Social Security uses that MAGI to place you into 2026 IRMAA brackets. Those brackets are cliffs. Cross one by a single dollar, and your monthly premiums jump for the entire year. It applies to both Part B and Part D, so the add-ons stack. This clicked for me when someone said, "But I didn't earn more this year. Why did Medicare go up?" Because the system isn't looking at this year. It's looking at the last processed return from 2 years ago. If the IRS sent over 2024, that sets 2026 premiums. If only 2023 is available, SSA can use that until a newer return arrives. Same logic, 2-year lookback, bracketed surcharges. Now here's where most people mess up. They assume AGI is the number that matters. IRMAA uses MAGI, which is AGI plus tax-exempt interest and certain add-backs. If you hold municipal bonds or have other exclusions, your MAGI can be higher than your AGI. Miss that, and you'll underestimate your exposure and get blindsided by a letter. Once you nail the definition, everything else clicks. IRMAA has a base premium, $202.90 for Part B in 2026, and then income tiers. If your 2024 MAGI is at or below $109,000 single or $218,000 joint, there's no IRMAA. Go above, and you add a surcharge based on the tier you crossed. Part D has a separate IRMAA add-on tied to your plan premium. The sting is the cliff design. $1 over triggers the full monthly surcharge for the entire year. Here's how that plays out. Say you converted extra IRA dollars in 2024 to fill a tax bracket. Smart tax planning can still trigger IRMAA later. If that pushed a single filer from $108,900 to $109,100, they crossed the first 2026 IRMAA threshold. That means a higher Part B each month, plus a Part D IRMAA add-on. Over 12 months, even the first tier adds up. Over 2 years, it stacks into the thousands. Another common trigger is the first required minimum distribution at age 73. The IRS forces it. It counts as ordinary income, and it lifts MAGI whether or not you needed the cash. You'll feel the tax hit that year, and 2 years later, the Medicare hit. That's the delayed pain retirees hate. No lifestyle change, but a higher monthly bill because the system reads a bigger paycheck on your return. Quick win. Grab your last filed return and compute MAGI, AGI plus any tax-exempt interest. Compare it to the IRMAA thresholds for your filing status. If you're near a cliff, you're in the danger zone. If you're over, note the tier, you can estimate your exposure for both Part B and Part D for 2026. Okay, so what if your income fell after that spike? Maybe you retired, sold the property, or lost a pension. This is where the better method comes in. You don't have to just accept the letter. If the drop was tied to a qualifying life-changing event, you can ask Social Security to use a more recent year's MAGI and lower or remove the surcharges. That's done with Form SSA-44. We'll get to that soon, and I'll show you exactly how to build a winning packet. Common mistake to avoid in the meantime: thinking, I can call and explain it's unfair. Appeals without numbers, documents, and the right event category usually fail. The system needs evidence. Also, don't ignore Part D. People focus on Part B and forget the drug plan add-on. It's a double hit. If you remember nothing else from this section, Medicare sets 2026 premiums from 2024 MAGI using cliff brackets. Income spikes from RMDs, Roth conversions, asset sales, or pension changes are the usual triggers. Check your MAGI now against the thresholds. In the next section, I'll translate those brackets into real dollars so you can see how fast the total climbs. The $12,480 hit, IRMAA Math in plain English. Now, let's see the real dollar damage. IRMAA isn't a gentle slope. It's a stair step. Go $1 over a bracket, and you pay the full surcharge for the entire year. A tiny mistake can cost hundreds per month. Quick refresher on 2026 numbers. The standard Part B premium is $202.90. If your 2024 MAGI is at or below $109,000 single or $218,000 married filing jointly, you pay that base. Cross the first tier, and Part B jumps to $284.10. Part D stacks a separate IRMAA. At the first tier, it's $14.50 on top of your plan premium. Higher tiers rise in steps. Part B can climb to $405.80, $527.50, $649.20, and $689.90, while Part D IRMAA adds $37.50, $60.40, $83.30, or $91. Your tier depends on how far over the threshold your 2024 MAGI went. Why this feels unfair is the cliff. Being $1 over doesn't cost an extra nickel. It triggers the full tier. So let me translate that into totals you can feel. Say you're single and your 2024 MAGI barely nudged into the first IRMAA tier. For 2026, your Part B goes from $202.90 to $284.10. That's $81.20 more per month. Part D adds $14.50 per month. Combined, that's $95.70 extra every month, or $1,148.40 for the year. Cross that line for 2 consecutive years. You've burned $2,296.80 simply by being $1 over a cliff each year. Now look at a higher tier, where many RMD plus capital gains scenarios land. Suppose your 2024 MAGI places you in the third tier. Part B at $527.50 is $324.60 above the base. Part D adds $60.40. That's $385 extra each month. Over 12 months, you're at $4,620 in surcharges. If both spouses cross together, double it, $9, $240 for the household for the year. 2 years of that pace, and you're staring at $18,480 of avoidable premiums if your income has since come down and you never filed a reset. Here's a quick anchor for one person. First tier, about $1,148 extra per year. Second tier, $202.90 base to $405.80 adds $202.90 on Part B plus $37.50 Part D equals $240.40 per month, or $2,884.80 per year. Third tier, $385 per month, or $4,620 per year. Fourth tier, $529.60 per month, or $6,355.20 per year. Fifth tier, $578 per month, or $6,936 per year. For a couple at the same tier, double those numbers. That's how we get to headline figures like $12,480. One common path is both spouses landing in the second or third tier for a full year or two after a spike. Think a year of large Roth conversions or big asset sales in 2024, then never appealing once income falls. Two spouses in the third tier for 1 year alone is about $9,240. Add a second year at a lower tier before the system catches up, and you're right in the $12,480 zone. The thing most people miss is Part D. They calculate the Part B increase and ignore the drug plan surcharge. But Medicare charges both. That's why the totals feel so heavy. If you only run the Part B math, your projection will be short by hundreds to thousands per year. Let me show you a quick estimation you can do in 2 minutes. Grab your last filed return and your 2024 MAGI. Identify your filing status. Use the 2026 brackets tied to 2024 income at or below $109,000 $218,000 joint means no IRMAA. Each bracket above adds the published surcharges. Multiply the monthly Part B increase plus the Part D IRMAA by 12. If you're a couple both on Medicare and both subject to IRMAA, double the total. That's your annual exposure. Now, a fast scenario to make it real. A married couple did a $150,000 Roth conversion in 2024 on top of pensions and Social Security. Their MAGI jumped them into the third tier. In 2026, each spouse pays about $385 extra per month. That's $770 monthly, $9,240 for the year. If their 2025 income also stayed above the cliff, even at a lower tier, they could easily stack another $3,000 to $6,000 the next year before SSA recalculates. That's exactly how 2 calendar years of Lookback produce a $12,480 hit. Common mistake right here. Assuming my investments went down or my income is back to normal cancels IRMAA automatically. It doesn't. The system runs on 2-year-old data unless you file for a new determination. And remember, market losses are not a qualifying event. Sell assets for gains? It counts. Watch the market fall? No relief. Quick win. Estimate your exposure today. If that number stings, don't panic. You'll see the reset path in the next sections, and I'll show you how to document it so you're not throwing away thousands over a technicality. The RMD Domino that triggers IRMAA. Here's what sneaks up on almost everyone: required minimum distributions. At age 73, the IRS forces withdrawals from traditional IRAs and most 401ks. That RMD is taxed as ordinary income, which lifts your MAGI whether you spend the cash or not. Because Medicare looks back 2 years. Income you didn't even want can hike premiums later. Why this matters is simple. RMDs raise taxes now and trigger IRMAA later. So you get a double bill. First from the IRS in the RMD year, then from Social Security 2 years later, when that higher MAGI drops you into an IRMAA tier. If you don't plan the timing and size of withdrawals, you can stumble over a cliff without realizing it until the letter shows up. What exactly counts toward MAGI here? The full taxable RMD, traditional IRA, and old employer plan distributions hit your AGI, add back tax-exempt interest and other adjustments, and you've got MAGI, the number Medicare uses. The reason this feels punitive is that our MDs don't care about your cash needs. The government wants the tax, so the withdrawal shows up like a paycheck, even if you reinvest it the next day. Let me show you the real timeline. Year 1, you turn 73 and take your first RMD in, say, December 2024. You pay the regular income tax for 2024. Year 2, you take the next RMD and think you've adjusted. Year 3, Medicare reads your 2024 return and, for 2026 coverage, adds IRMAA to your Part B and Part D. That's the 2-year lag at work. The pain spreads over time. Tax hit first, Medicare hit later. Here's a clean example. You've got a $600,000 IRA on December 31st, 2023. Using the Uniform Lifetime Table, your 2024 RMD at age 73 is roughly 3.8%, about $22,800. Add that to Social Security and a small pension, and your MAGI can jump from under the $109,000 single threshold to slightly over $1 over the line. And in 2026, your Part B premium jumps from $202.90 to $284.10, and Part D adds $14.50. That's the cliff effect we just walked through. Now, here's where most people mess up. They take the entire RMD in December without coordinating anything else. That 1 month may also include capital gains distributions from mutual funds, a small Roth conversion they forgot about, or a property sale closing. Stack those on top of the RMD, and you've manufactured a bracket crossing you could have avoided by spacing income earlier in the year or shifting transactions. Once you nail the RMD mechanics, coordination is the game. Most people miss sequencing. If you plan Roth conversions, spread them in years before RMD start, when MAGI is lower. After 73, conversions stack on top of RMDs and can shove you into higher IRMAA tiers fast. If you're charitably inclined, qualified charitable distributions, QCDs, from your IRA after age 70 and a half can satisfy part or all of your RMD without raising MAGI. That's a simple way to lower IRMAA risk while meeting giving goals. Let me show you exactly how a small tweak helps. A client with that same $600,000 IRA plan to take the full RMD in December, plus sell appreciated shares. We split the RMD into quarterly withdrawals, postponed the sale into the following tax year, and used a QCD to cover $10,000 of the RMD. The result? Their 2024 MAGI stayed below the first IRMAA cliff, so their 2026 Medicare premiums remained at the base rates. Common mistakes to avoid: treating RMDs as a December chore, doing Roth conversions on top of RMDs without a bracket map, and forgetting that mutual fund capital gains distributions hit late in the year. Another miss is ignoring Part D IRMAA. Drug plan surcharges are tied to the same MAGI tiers and can tip a plan from affordable to painful. Quick win you can do this week: create a simple RMD calendar. Mark the RMD amount, schedule withdrawals across the year, list other known income items, and run a rough MAGI estimate. If you're near a cliff, consider a QCD or move optional income into a different year. And loop in a tax pro to pressure test the plan. Once you coordinate RMD timing, everything else clicks. And for couples, remember the widow's penalty. The same RMD dollars taxed under single brackets and single IRMAA thresholds can push a survivor over cliffs faster. That's why smoothing income before 73 and using QCDs after 70 and a half matters even more. In a minute, we'll connect that to the filing status shift and the reset many survivors miss. Widow's penalty meets Lookback. Here's what hits couples the hardest. When one spouse dies, the survivor's filing status changes, and the brackets compress. Same dollars, tighter space. That's the widow's penalty. And when you stack it on the 2-year look back, you get a delayed premium jump right after a life shock. Here's why this matters. While you're married filing jointly, the IRMAA thresholds are wider, $218,000 for 2026 before any surcharge. After a spouse passes, the survivor typically files as single the next year, and the first IRMAA cliff drops to $109,000. That's half the runway. The survivor didn't suddenly get a raise. The rules just moved the goalposts. What the system actually does is simple, but brutal in timing. Medicare reads the IRS data from 2 years earlier. So if your spouse died in 2025, your 2026 Medicare bill is based on 2024 income, likely a joint return. You might still be safely under IRMAA for 2026. Then 2027 arrives. Now Social Security looks at your 2025 return, which is the year of loss and transition. That's where single status compresses the brackets, and the IRMAA letter often shows up. You're grieving, your household income may be lower, but the premium can go up because the threshold shrank. Let me show you exactly how it plays out. A couple had $185,000 MAGI in 2024, comfortably under the joint threshold. In 2025, the husband passes. The survivor's 2025 MAGI falls to $120,000, less income than before. But as a single filer, $120,000 sits above the $109,000 cliff. 2 years later, in 2027, Medicare charges IRMAA based on that $120,000. The survivor feels like, I'm earning less. Why did my Medicare go up? Because filing status changed, not income behavior. The thing most people miss is that the widow's penalty hits taxes and Medicare at the same time. Single tax brackets are narrower, standard deduction is smaller, and IRMAA thresholds are tighter. The same IRA distribution that was harmless as a couple can cross a cliff alone. Add RMDs, and the risk grows with age. It's not malice, it's how the rules are written. Now here's the part that actually helps. Form SSA-44 recognizes the death of a spouse as a life-changing event. If your income dropped because of the loss, Social Security benefit reduction, smaller pension, missing wages, you can request a new initial determination and ask SSA to use your current year MAGI instead of the old 2-year data. This is the reset many survivors never file. Here's what SSA wants to see. First, check death of your spouse on SSA-44 and enter the date. Second, show the prior year MAGI SSA used, then your current year estimate, and, if helpful, next year's estimate. Third, attach proof. The death certificate, any 1099 are showing a pension stop or reduction, Social Security benefit change notices, and recent statements that reflect the lower income. The mistake that gets automatic denials? Listing AGI without adding back tax-exempt interest. SSA uses MAGI. If muni bond interest pushes MAGI above a cliff, they'll deny it. Show the full MAGI math on a 1-page worksheet and attach the supporting documents. A quick micro story. A widow named Carol saw her 2026 premiums stay at the base rate because Medicare used their 2024 joint return. In late 2026, she got a notice for 2027 IRMAA. Her single 2025 return had $116,000 MAGI. She assumed nothing could be done and was ready to pay. We filed SSA-44 with the death certificate. A 1099 are showing her late husband's pension stopped and a current year MAGI estimate of $94,000. SSA approved a new determination and removed IRMAA. The difference? Evidence plus the correct event box and MAGI, not AGI. Common mistakes to avoid. waiting until after premiums start to file, submitting a narrative with no documents, choosing the wrong event, checking work reduction instead of death of a spouse, and forgetting Part D is included in the same appeal. Another big one is mismatched dates. Make sure the life-changing event date on SSA-44 matches the death certificate. Quick win for survivors. Build a pre-planned SSA-44 packet within months of the loss. Keep a folder with the death certificate, the Social Security benefit change letter, any pension stop notices, your most recent tax return, and a MAGI estimate for the current year. When the IRMAA letter arrives, you're ready to send a clean, credible packet immediately. And once you stabilize this year, think forward. RMDs under single brackets can push you over cliffs more easily. Coordinate QCDs after 70 and a half, smooth IRA withdrawals, and map your MAGI quarterly. The goal is simple. Keep your single filer MAGI away from the IRMAA cliffs. In the next section, I'll show you the reset button in detail, how to complete SSA-44 line by line. So you don't leave money on the table. Form SSA-44. Here's the shortcut nobody teaches. If your income dropped because of a qualifying life-changing event, Social Security can use your current lower MAGI instead of that 2-year-old spike. The tool is Form SSA-44. Used right, it can erase both Part B and Part D IRMAA, sometimes immediately. Why this matters? Paying IRMAA for a year when your income fell is unnecessary cash burn. The SSA-44 is the legal path to reset premiums after events the rules specifically recognize. Do it well, and you keep thousands. Do it sloppily, and you get a quick denial. Let me show you exactly how to do it well. What qualifies as a life-changing event? SSA lists 8 reset codes they accept: marriage, divorce, or annulment, death of your spouse, work stoppage, full retirement counts, work reduction, fewer hours, lower pay, loss of income-producing property, disaster, theft, or condemnation, loss of pension income, employer settlement payment, ending or reduction. Now, what SSA-44 asks for is simple in structure but strict in evidence. The form has 4 core pieces. Step 1, you select the event and enter the date, month, and year. Step 2, you show your most recent MAGI that SSA used, usually 2 years prior. Step 3, you estimate your current year MAGI and optionally next year's if the reduction continues. Step 4, you attach documentation that proves both the event and the new income. Let me show you exactly how to avoid the number 1 denial. IRMAA runs on MAGI, not AGI. MAGI is AGI plus tax-exempt interest and certain add-backs. If you put AGI and ignore muni bond interest, SSA will reject it because your MAGI is higher than you claimed. So include a 1-page MAGI worksheet. Start with AGI from your tax software or draft return, add tax-exempt interest, note any add-backs, and show the final MAGI. Attach the statement or 1099 that proves those amounts. Documentation is the engine. Here's the proof stack SSA expects by event: death of spouse, death certificate, Social Security benefit change letter. 1099 are showing a stopped or reduced pension, and a current year income snapshot, pay stub, bank statement with reduced deposits, or advisor letter summarizing expected RMD/QCD amounts. Work stoppage/reduction. Employer letter on letterhead stating the last day worked or the hour/pay reduction date, and new pay rate, plus recent pay stubs showing the change. Divorce/annulment. Divorce decree showing date, and any support/benefit termination documents. Loss of income-producing property. Insurance claim, police report, disaster declaration or condemnation order, plus prior Schedule E showing the old income and current evidence showing the loss. Loss of pension income. Plan letter confirming the reduction/termination and date with a 1099 are if available. Marriage certificate, and a clear MAGI estimate for the new household if relevant to filing. How do you estimate current year MAGI credibly? Use a show your work approach. Draft a simple pro forma. Social Security benefits, taxable portion still flows from combined income. Pensions, IRA withdrawals or RMDs, interest and dividends, and any part-time work. If you'll do QCDs, note them to reduce taxable IRA withdrawals. If you'll avoid capital gains harvesting, state that. Then list tax-exempt interest and add it to AGI to land on MAGI. Keep it conservative, round slightly higher, so reality won't exceed your estimate. Let me walk you through a clean filing example. Susan retired mid-2025 after a one-time 2024 Roth conversion that triggered 2026 IRMAA. In 2026, she files SSA-44 selecting work stoppage, date June 2025. Step 2 shows 2024 MAGI the IRS sent to SSA. Step 3 estimates 2026 MAGI using pension, Social Security, and a smaller IRA draw, adds tax-exempt interest to reach MAGI. Step 4 attaches her employer retirement letter, final pay stub, pension 1099-R, Social Security benefit statement, and her MAGI worksheet. She notes number 2026 capital gains planned. IRA giving via QCD will satisfy $8,000 of RMD. SSA issues a new determination and removes IRMAA for Part B and D. Now here's where most people mess up. Picking the wrong event box, mark work reduction when you fully retired, or marking loss of income producing property for a stock market loss. Market declines don't qualify. Submitting AGI instead of MAGI. Missing dates or mismatching the event date with the document date. Sending a narrative with no proofs. Forgetting that Part D IRMAA is appealed through the same process. Don't separate the two. Quick win. Assemble your packet in this order. SSA-44 on top. A one-page cover note that bullets your event, dates, prior MAGI, current MAGI estimate, and attached proofs. Then the proof stack. Then your MAGI worksheet. Finally, your contact info with best phone and email. Keep a full copy. If possible, hand deliver to a local office and get a receipt, or upload through your SSA account if available. Timing tip: file as soon as the income drop is real and documented. If the event is death of a spouse, divorce, or employer letter, you can file quickly. If your proof is a 1099-R or insurance claim, wait until you have it in hand to avoid delays. Remember, SSA can use your current year once you show the reduction is already happening. If SSA denies you, you're not done. Many denials are fixable with a clearer MAGI worksheet, better documents, or the correct event box. We'll cover reconsideration and appeals shortly. For now, know this: the SSA-44 is your reset button. Use the right event, prove the drop, do MAGI math, and you can erase IRMAA you don't actually owe anymore. Preventive planning to dodge IRMAA. The best IRMAA is the one that never triggers. Prevention starts with a multi-year MAGI map, not a one-year scramble. Think in 3 lanes: awareness of brackets, control of taxable inflows, and charitable or timing tools that legally lower MAGI without shrinking your lifestyle. First, bracket awareness. For 2026, the first IRMAA cliffs sit at $109,000 single and $218,000 joint. Build simple guardrails 5 to 10% below those numbers to give yourself room for surprise dividends, mutual fund capital gains, or one-off 1,099s. If your forecasted MAGI runs close to a cliff, plan to offset or postpone optional income. This isn't about deprivation. It's sequencing. Now, control the levers you actually touch. Make a list of the usual MAGI drivers: pensions, Social Security, IRA distributions and RMDs, part-time wages, interest, dividends, capital gains, and tax-exempt interest. Color code them by flexibility: green for fully optional, yellow for shiftable, red for mandatory. Greens include elective IRA withdrawals, Roth conversions, and harvesting gains. Yellows often include the timing of asset sales, mutual fund distribution exposure, and the month you take RMDs. Reds are your pension and Social Security. Your job is to downshift greens and yellows in years when you're near a cliff. Here's the shortcut nobody teaches: quarterly MAGI checkpoints. Spend 15 minutes, 4 times a year, updating your MAGI estimate. January sets the baseline. June catches drift, October tightens year-end, and December confirms any last moves. The reason this works is compounding surprise is the enemy. Quarterly visibility kills surprise. Charitable tactics are powerful. After age 70 and a half, qualified charitable distributions, QCDs, let you give directly from your IRA to a qualified charity. Those dollars count toward your RMD but don't land in AGI, which keeps MAGI down. If you give anyway, QCDs are a double win. You meet your gifting goals and avoid inflating the numbers that trigger IRMAA. Do them early in the year so you're not scrambling in December, and keep the custodian's confirmation to back up your tax return. Roth conversion strategy needs nuance. Conversions can be smart for lifetime tax planning, but they raise MAGI in the year of conversion. The move is to convert in lower income years, ideally before RMDs start, and cap conversions under your IRMAA guardrail. Once RMDs begin, remember you must take the RMD first. Conversions are on top and can shove you over cliffs fast. Many people benefit from partial conversions in the window after retirement, but before Social Security or pension income fully loads in. On investments, reduce accidental capital gains. Mutual funds can distribute gains late in the year, even if you didn't sell. Check distribution estimates by October. And, if needed, shift new money to tax-efficient funds or ETFs. If you plan to harvest gains, consider doing so in a year with MAGI headroom. If markets hand you losses, tax loss harvesting can offset gains. But remember, harvesting losses doesn't reduce interest, dividends, or RMDs. Coordinate pensions and annuities. If you can choose start dates or amounts, model how those decisions echo through MAGI over several years. Sometimes delaying a small annuity or structuring income evenly prevents a single-year spike that kicks IRMAA into gear. The same goes for real estate sales. Use exclusions where applicable, but model the taxable portion before you close. For couples, plan with the widow's penalty in mind. The survivor's IRMAA cliff is half as wide. Smoothing IRA balances with partial Roth conversions before age 73 can reduce future single-filer RMD pressure. Consider beneficiary designations and spousal rollover timing, so the survivor isn't forced into outsized distributions in the first single status year. A practical playbook to run with your advisor. Build a 3-year MAGI forecast with conservative assumptions for dividends and interest. Set IRMAA guardrails 5 to 10% below the thresholds for your filing status. Schedule QCDs early. Decide RMD cadence quarterly, not in December. Cap Roth conversions to stay under your guardrail in pre-RMD years. Check mutual fund distribution estimates in October. Avoid buying funds right before distributions. Stagger asset sales. Don't stack conversions, gains, and RMDs. In the same MAGI year, if you're near a cliff, common mistakes to avoid. Year-end surprises from mutual fund distributions, taking the entire RMD in December alongside capital gains, converting to Roth after RMDs without realizing it stacks, and never accounting for tax-exempt interest in your MAGI math. Another big one is skipping quarterly checks. Small mid-year adjustments are painless. December rescues are messy. Quick when you can do in 15 minutes today. Open a note titled MAGI Guardrails. Write your 2026 threshold for your filing status, subtract 10%, and set calendar reminders for March 31st, June 30th, and October 15th labeled MAGI Check. On the same note, list QCD target amount if you give, RMD monthly or quarterly cadence, and any planned conversions with a cap. Share the note with your tax pro or advisor. Once you make MAGI visible and rhythmic, IRMAA gets boring, and boring is 2026 cheap. Perfect storm setup. Before we dive into the sprint playbook, see the storm on the horizon. 2026 isn't just another calendar flip. It's the year two forces collide. Medicare's two-year Lookback, using 2024 income, and the scheduled sunset of the Tax Cuts and Jobs Act, which makes taxable income harder to control even if your lifestyle doesn't change. Why this matters? When tax brackets revert to pre-2018 levels in 2026, your ordinary income can be taxed at higher rates at the same dollar amounts. That doesn't directly change IRMAA brackets, but it changes behavior. Higher marginal rates shrink the room you feel safe using for Roth conversions, nudge more RMD dollars into higher tax, and make every avoidable dollar of MAGI more expensive. And because Medicare is pricing 2026 off 2024 returns, many households will walk into January already locked into higher Part B and D bills while facing tighter tax math at the same time. Here's the simple translation. In 2026, key brackets move up. Today's 12% moves toward 15%, 22% toward 25%, and the top bracket rises. Practically, that means the cheap room for conversions or elective income gets smaller. So the two-year Lookback keeps your Medicare surcharges higher from prior spikes, while the new tax landscape punishes current year income more than you expect. Same dollars, worse outcomes. Now here's where most people mess up. They wait for Congress to do something. Planning paralysis is expensive. The game is to plan for the law on the books and use your flexible levers early. If rules change later, great, you can adjust. But doing nothing in 2025 often sets up both a tax hit in 2026 and an IRMAA hit in 2027 because of the Lookback. So, what's the better method? Build a two-year ramp that smooths income before and through 2026. Step 1. Audit 2024 and 2025. If 2024 is already locked and will cause 2026 IRMAA, your move is defensive. File SSA-44 if you qualify, and keep 2025 MAGI under your 2027 cliffs. Step 2. Treat 2025 like a last chance optimization year. If you need Roth conversions, consider modest bracket-capped amounts in 2025, only if they won't push you into an IRMAA tier for 2027. Otherwise, hold fire and plan conversions for 2027 to 2028 when you have more control post-retirement or after RMD coordination. Let me show you how a simple two-year plan plays out. Year A, now through December 31st, 2025, run a mid-year and fall MAGI check. Cap elective income, so your 2025 return doesn't create a 2027 IRMAA surprise. Complete QCDs early, split RMDs to avoid stacking with mutual fund distributions, and avoid buying funds before capital gains payouts. If you're retiring in 2026, pause big conversions in late 2025. So your first single post-wage year has more room. Year B, 2026, accept that your 2026 Medicare is priced off 2024. If your income fell due to a qualifying life-changing event, retirement, death of a spouse, work reduction, loss of pension, file SSA-44 with clean MAGI math to reset Part B and D. For taxes, model the reverted brackets. You'll likely favor more QCDs, tighter RMD sequencing, and fewer elective capital gains. If conversions make sense, they may be smaller and more frequent across 2027 to 2028, where you can keep each year under the IRMAA cliffs while still shrinking future RMDs. The game changer nobody talks about is bracket creep without action. If you let 2026 glide, you risk stacking 3 hits: a locked-in IRMAA from 2024, higher tax on 2026 income, and a new IRMAA letter for 2028 if 2026 MAGI drifts. The fix is structure. Use guardrails, quarterly MAGI checks, and pre-scheduled QCDs. For widows and widowers, build around single brackets, half the runway, and the same RMDs can cross cliffs easily. Pre-73 partial conversions beneficiary strategy and early QCDs give the survivor breathing room. A quick micro plan you can steal. Perfect storm checklist. Today, note your 2026 IRMAA tier based on 2024 MAGI. This week, set 2025 guardrails 5 to 10% under your 2027 thresholds. Schedule QCDs for early 2025. Split RMD into quarters. Turn off automatic investment distributions you don't need. In January 2026, run a fresh MAGI projection under reverted brackets. Decide if small surgical conversions start in 2027. Pre-draft SSA-44 if you'll have a qualifying event. By October each year, confirm mutual fund distributions and adjust. Don't wait for perfect certainty. The rules are rigid, but you control timing, sequencing, and documentation. Plan for the 2026 storm as if it's guaranteed. If policy shifts later, you'll still be in better shape, lower spikes, fewer cliffs, and cleaner SSA-44 filings when you need them. The 7-day IRMAA reset sprint. Let's turn this into action. 7 days, one clean packet, lower premiums. Day 1, gather your numbers. Pull your last 2 filed returns, your 2024 return if filed, Social Security benefit statements, pension 1099, RS, and IRA RMD statements. Write today's filing status and your 2026 IRMAA threshold. $109,000. Single, $218,000 joint. Drop everything into a folder called IRMAA Reset 2026. Day 2, pick your reset code. Ask, what single event caused my income to drop? Choose the exact SSA-44 life-changing event. Work stoppage, work reduction, marriage, divorce/annulment, death of spouse, loss of pension income, loss of income-producing property, disaster, theft, condemnation, or employer settlement payment. Circle the event and write the month/year from the official document. If you're torn between two, pick the one with the strongest dated proof. Day 3, build your MAGI estimate. Create a simple worksheet. Line 1, AGI estimate for the current year, pension, taxable IRA/RMD, wages, taxable interest/dividends, gains if any. Line 2, add tax-exempt interest from 1,099 INT. Line 3, note any add-backs relevant to MAGI. Line 4, total MAGI. Be conservative. If you plan qualified charitable distributions to shrink taxable IRA withdrawals, note the amount and keep custodian confirmations. If you'll avoid harvesting gains, say so. Your goal is credibility, not perfection. Day 4, assemble proof. Match documents to your event. Work stoppage/reduction. Employer letter on letterhead with effective date, and new pay/hours, last full pay stub and first reduced stub. Death of spouse, death certificate, Social Security benefit change letter, pension stop/reduction letter or 1099, our divorce/annulment, decree with effective date, updated income statements, loss of pension income, plan administrator letter with date, and new amount, current 1099, are loss of income producing property, insurance claim, police report, disaster/condemnation order, prior Schedule E, and current statement showing income stopped. Marriage certificate, combine MAGI estimate if relevant. Place the strongest proofs first. Highlight dates and amounts. Keep originals, send copies. Day 5, fill SSA-44 cleanly. Step 1, check the event and enter the month/year. Step 2, list the prior MAGI SSA used, likely 2024. Step 3, enter your current year MAGI estimate, and, if helpful, next year's. Step 4, check the documentation you're attaching. Sign and date. add a one-page cover note that bullets event/date, prior MAGI, current MAGI, attachment list, and the request to use current year MAGI for Part B and D. Day 6, create your submission kit. Order it. SSA-44 cover note, event proofs, income proofs, pay stubs, 1099s, benefit letters, MAGI worksheet, contact sheet with best phone/email and permission to call you or your advisor. Save PDFs with clear names. 2026 SSA-44.pdf. Employer letter 2025-06.pdf. MAGI worksheet 2026.pdf. Have a friend or advisor sanity check the packet for the 3 killers: wrong event box, AGI instead of MAGI, mismatched dates. Day 7, file and confirm. If possible, hand deliver to your local SSA office and request a date-stamped receipt. If not, upload via your SSA online account or mail track to your local office. Immediately call SSA to confirm receipt and ask if anything else would help the reviewer. Set a follow-up reminder for 21 days. If you're already being charged IRMAA, ask whether an approved new initial determination will adjust the remaining months this year. Call script you can use. Hi, I filed Form SSA-44 for a new initial determination due to event on date. My packet includes proof and a MAGI worksheet. Can you confirm receipt? And note my file that I'm requesting current year MAGI for both Part B and Part D. 2 final guardrails for this sprint. Don't argue fairness, prove facts. Event, date, documented income drop, true MAGI. Don't wait for months of overpaying. The moment you can document the reduction, file. Quick win if you're mid-year. Submit now. If approved, the lower premium applies going forward. If denied, you'll know exactly what to fix for reconsideration. This sprint turns a confusing rule into a clear checklist and keeps that money in your pocket where it belongs. Common mistakes that cost you. Let's tighten the bolts. These are the small errors that trigger big denials and months of overpaying. Mistake 1, checking the wrong event box. If you fully retired, it's work stoppage, not work reduction. If your spouse died, it's death of your spouse, not work reduction. Mislabeled events are an easy automatic no. Mistake 2, using AGI instead of MAGI. IRMAA uses MAGI. That's AGI plus tax-exempt interest and certain add-backs. If you omit muni bond interest, SSA recalculates and your estimate collapses. Always attach a one-page MAGI worksheet that shows your math. Mistake 3, missing or mismatched dates. The event date on SSA-44 must match the employer letter, death certificate, divorce decree, or plan notice. June on the form and July on the letter looks sloppy and can stall approvals. Mistake 4, submitting a narrative with no proof. Stories don't move premiums, documents do. Led with employer letters, benefit change notices, 1099-R forms, and official certificates. Highlight the lines that show date and amount. Mistake 5, claiming non-events. Market losses, choosing to sell fewer shares, moving homes, or paying off a mortgage aren't qualifying events. Loss of income-producing property requires a disaster, theft, or condemnation with documentation. If it's not on the SSA list, don't force it. Mistake 6, forgetting tax-exempt interest. Even a few thousand in muni interest can push you over a cliff. If you hold municipal bonds or funds, pull the 1099 INT, add it to AGI, and show the total as MAGI. Mistake 7, ignoring Part D. SSA-44 resets both Part B and Part D. Don't appeal one without the other. Write new initial determination for Part B and Part D in your cover note. Mistake 8, filing too early with no evidence. If you're reducing hours or retiring, wait until you have the employer letter and a first lower paycheck, or the 1099 are showing a pension change. File as soon as the drop is real and documented. Mistake 9, stacking income in December. taking the full RMD, the same month mutual funds distribute gains, plus closing an asset sale, is how people blow past a cliff. Split RMDs, do QCDs early, and push elective gains into a different year. Mistake 10, no second set of eyes. A 5-minute review catches the killers. Wrong event box, AGI instead of MAGI, and date mismatches. Have a spouse, advisor, or tax pro eyeball the packet. Mistake 11, resending the same packet after denial. Don't argue. Fix what SSA flagged. Correct the event, show true MAGI, upgrade documents, and mirror the denial language in your cover note so the reviewer sees you addressed it. Mistake 12, year-end surprises. Mutual fund capital gains often hit in November or December. Check estimates by October. If they'll push you over, adjust RMD cadence, increase QCDs, or avoid buying funds before distributions. Quick pre-flight checklist, correct event box, and exact date. MAGI worksheet attached, muni interest included, cover note with event/date, prior MAGI, current MAGI, and document list. Proof stack, employer letters, certificates, benefit notices, 1099s. Ask for Part B and Part D redetermination. Clear contact info and permission to call. Copies saved, submission receipt requested. Do this, and your odds of a clean yes go way up. If you remember nothing else, remember this. IRMAA is triggered by 2-year-old MAGI, and SSA-44 is your legal reset when income truly drops. Use it with proof. Want help dialing this in? Grab the free SSA-44 packet checklist and run the 7-day reset sprint now. Then watch my simple RMD timing video to prevent next year's IRMAA. Subscribe for weekly traps and fixes that keep more of your money in your pocket.